Here's a question. Here's a question. If you invested $200 a month starting at age 25 and just left it alone, how much would you have by 65? The answer is close to $700,000. Now, here's the uncomfortable part. If you wait until 35 to start, just 10 years later, that number drops to around $300,000. Same $200 a month, but losing just one decade cuts your final balance by more than half. That gap right there is the entire reason this video exists. Today I'm breaking down index fund investing for complete beginners. What an index fund actually is, why it's the single most recommended investment for regular people, exactly which funds to consider, how to actually buy one, and the real math behind why starting now beats starting smarter later. Let's start with the basic question. What is an index fund? An index fund is a single investment that automatically buys a little piece of hundreds or even thousands of companies at once. The most common one tracks the S&P 500, which is a list of roughly 500 of the largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, and hundreds of others. When you buy one share of an S&P 500 index fund, you're not betting on any single company. You own a tiny slice of all of them at the same time. That's the whole idea. Instead of trying to guess which individual stock is going to be the next big winner, you just buy the entire market and let it grow over time. Here's why that matters. There's a famous bet from a number of years back where Warren Buffett, arguably the most successful investor of all time, put $1 million on the line, wagering that a simple low-cost S&P 500 index fund would outperform a group of hand-picked hedge funds over a 10-year period. The hedge funds had professional managers, expensive research teams, and access to every tool available. The index fund had none of that. It just tracked the market. Buffett won, and it wasn't close. The index fund significantly outperformed nearly every actively managed alternative. And this isn't a one-time fluke. Study after study shows that the vast majority of professional fund managers fail to beat the S&P 500 over the long run, especially once you factor in their fees. That's the first big lesson. You don't need to be a genius stock picker. You just need to own the market and be patient. So which index funds should you actually look at? A few of the most well-known low-cost options include the Fidelity 500 Index Fund, ticker FXAIX, with an expense ratio around 0.015%. The Vanguard S&P 500 ETF, ticker VOO, and Vanguard Total Stock Market ETF, ticker VTI, both around 0.03%, and the Schwab S&P 500 Index Fund, ticker SWPPX, around 0.02%. Notice how tiny those numbers are. An expense ratio is the annual fee the fund charges you as a percentage of your investment. A 0.03% expense ratio means you're paying about $3 a year for every $10,000 invested. Compare that to older actively managed mutual funds, which often charge 1% or more. And over decades, that fee difference alone can cost you tens or even hundreds of thousands of dollars in lost growth. When it comes to index funds, cheaper is almost always better, because you're getting the same market exposure for a fraction of the cost. Now, how do you actually buy one? You'll need a brokerage account. That could be a taxable brokerage account through a company like Fidelity, Vanguard, or Schwab, or better yet, a tax-advantaged account, like a Roth IRA, where your investments grow completely tax-free as long as you follow the withdrawal rules. Opening one of these accounts typically takes about 10 minutes online, and most have no minimum balance requirement. Once it's open, you transfer money in, search for the ticker symbol, like VOO or FXAIX, and buy shares either as a one-time purchase or ideally as an automatic monthly contribution. That second part is called dollar cost averaging, and it simply means investing a fixed amount on a regular schedule, regardless of whether the market is up or down that day. It removes the guesswork and the emotion from investing. Now let's get to the math, because this is where index fund investing actually gets exciting. Let's say you invest $200 a month into an S&P 500 index fund starting at age 25. Using the market's long-term historical average return of around 8 to 10% a year, I'll use 8% for this example to be conservative. That account grows to roughly $698,000 by age 65. You would have personally contributed about $96,000 of your own money over those 40 years. Everything above that, over $600,000, is pure compound growth. Money the market made for you, simply because you stayed invested and gave it time. Now compare that to someone who waits until 35 to start the exact same $200 a month habit. They only lose 10 years, but their ending balance drops to around $298,000. That's a difference of over $400,000 for a gap of just $24,000 in total contributions. 10 years of waiting costs them nearly 17 times what they saved by delaying. And now compare both of those to someone who never invests at all, who just keeps that same $200 a month sitting in a checking account with no growth. After 40 years, they'd have exactly what they put in, $96,000, not $1 more. Even putting that money in a basic savings account, earning 2%, only grows it to about $147,000. Still a fraction of what investing in the market produced. The difference between saving and investing isn't small. It's the difference between $96,000 and nearly $700,000 using the exact same amount of money. That's the power of compounding. And it's the reason financial advisors always say the same thing. Time in the market matters more than timing the market. Before you go open an account, let's cover the most common mistakes beginners make. The first is trying to time the market, waiting for a dip, waiting for a crash, waiting for the right moment. Nobody can consistently predict short-term market movements, not even professionals. The market has historically trended upward over long periods, so the best time to start is simply now. The second mistake is panic selling during a downturn. Markets drop sometimes. That's normal and expected. Selling when prices fall locks in your losses permanently. Staying invested through the dips is what allows you to capture the recovery. And the third mistake is picking individual stocks before you have a solid foundation. It's tempting to chase the next big company. But for most beginners, a broad index fund should be the base of your portfolio before you ever consider anything riskier. So, to bring it all together, an index fund lets you own the entire market instead of betting on one company. The fees are tiny. Historically, it beats most professional stock pickers. And it's about as simple as investing gets. Open an account, pick a low-cost fund like VOO, VTI, or FXAIX, set up an automatic monthly contribution, and then do the hardest part of all, nothing. Just let it compound. Quick disclaimer, I'm not a financial advisor, and this video is for educational purposes only. All figures shown are hypothetical projections based on historical average returns, not guarantees. The market can and will go down as well as up, and you should consider talking to a licensed financial professional before making investment decisions. If this helped make investing feel less intimidating, subscribe for more breakdowns like this one. And let me know in the comments. What age did you start investing? Or what age are you starting today?